Good evening, Marshall Reddick members. I am so pleased to have you on tonight. This is such a hot topic right now. Interest rates have been doing so many great things, staying low so that more people can get into the market and buy to have higher returns. So, financing for real estate investors in 2017. The next slide is going to be me. This is me. I'm a realtor, been licensed for a little over 5 years now. I am a broker here in California. I really enjoy what I do. I basically grew up in this network, and my parents bought plenty of properties. So, kind of came to a ton of events growing up and have been here with Marshall Reddick for about 4 years now. Let's go
Wonderful.
on to the next slide. I think this is super important. Let's go ahead and I want to let you guys know that this is an interactive webinar. So you'll be able to see an area where you can type. So if you could please type, yeah, I can hear you just fine, or maybe you guys are wondering what in the world's going on and you guys see the screen moving, but you don't. Yep, if you guys continue just typing in, I can hear you just fine, etc.
Perfect.
That would be great. Okay, so I'm going to type a message, and if you guys can type back, I'm not seeing anything. Oh, good. Okay, hi, Mike. Yep, hi, Marcella. Hi, Robert. Okay,
Perfect.
good. It's starting to trickle through now. I was getting a little worried there. Thanks, guys. All right. Next slide. I think it should be that we're okay to move forward. Thanks, Roxy. All right. So, a little bit about me. I am a licensed broker. I invest in real estate myself, following in my parents' footsteps, and my parents followed in their parents' footsteps. So I kind of grew up helping out with all of our rentals. So it's been quite fun. I've learned the power and all the fun tricks of real estate investing throughout the years. I'm a numbers girl, Cal State Long Beach. So that's a little bit about me and how I'll be able to help you through investing. The next slide, please. Here we are. So, a little bit about Marshall Reddick Real Estate. We do everything under the sun for investing. So, whatever you need, we will have vendors for. So, it's basically, I guess a lot of people say, a one stop shop, and they're very surprised at all the vendors that we've selected over the years. We've been around for over 30 years. So, every state that we help people buy in, we have the whole team. So we have the property manager, we have the 1031 exchange accommodator, we have the insurance person. So everything that you'll need, we'll be able to help you get it done right. So no worries throughout the whole process, and that's what I kind of do. We teach tons of different topics. So let's continue on about why we choose where we invest. The job market has to be really strong. We're not going to put you in the middle of nowhere. Like we're never going to put you in an area that it's a one industry place, like car manufacturing or oil industry, where it's just one thing, and if that dries up, then you have no more tenants to help you with your investment. So the job market has to be strong. Texas is a really strong market, right? Everyone reads articles about that and how it's business friendly. All the areas that we're in are highly driven towards um, job friendly markets. Vacancy rate, that's super important to understand that the more jobs there are creates less vacancy for you and people that will be able to pay. Next is going to be economic diversity, making sure that it is affordable to live there. Reed, if you can go through these, they kind of all tie hand in hand in hand as we go. So the economic diversity, people are able to pay. Then the next step, the building block is the housing affordable. So we go to places where it still makes sense for the down payment and the median incomes for people that are looking to buy. Maybe it's just more affordable for them to rent. Is it a landlord friendly state? California is definitely not a landlord friendly state, but all the areas that we are in are specifically geared towards investor-friendly markets. So if we can go to the next slide, basically we always invest in areas that have strong education, lots of college institutions nearby because it holds a, stronger employment base. And most importantly, we have property management set up in all of these states that you see here in front of you. So if anything looks really appealing to you, like maybe you've never really thought about investing outside of California, I get that. I help people buy all day, every day here locally. In Riverside County has been very popular. There's a lot of growth going on over there for investing. Orange County, people are buying and selling primary homes and multifamilies. Los Angeles is great as well. It's just sometimes we run into rent-controlled areas. But everywhere else, if you guys can use the type chat box and say, XYZ looks appealing to me. I'm here because I need to do what's a hot topic. We're going to refinance, right? Are you on this because you're looking to buy more, to learn what the guidelines are? Just let me know what you're on here for. That would be really awesome. Great question, Robert. I'm going to let Reed talk about what areas he's in. Yep, new guidelines are super important. Refinancing guidelines, great. All right, Texas. Yes, Texas definitely has different lending rules, and same with Florida, you guys. So let's go ahead and I know that you guys are definitely already utilizing this, so this is quite fun. It's time for a poll. Let's go to the first poll. This is kind of going to help you. We're going to have a couple throughout the webinar. So here we go. You're mainly here for, and we have a few, but I kind of like to hear you guys' creative specific reasons before I launch this. So first, you're mainly here today because you want to find out what your loan options are. Second one is to hear market updates, which is always a popular one, and make my decision on choosing a good lender. Because you guys know what? Not all lenders are the same. Just like agents, everything, you guys know, not all your teachers were the same quality either. So, okay, I'm going to pretty soon close this poll out. It seems like only 70% of you guys have voted. I'm going to close it out in just one more second, give a couple more people to do this before I share your guys' results. All right, can you guys see the results here? Seems like about 63% of you are here to see what's going on. Well, that's good because this is the right place to be. And 19% of you are here to learn about market updates, and another 19% make your decision on how to pick a lender. All right, so here we are. I'm going to go ahead and close this. And next, I'm here to introduce Reed Hazard. He is with the Rodriguez Hazard team. And, I've worked with Reed for, gosh, we've worked with him for over 10 years. I've successfully closed over 200 transactions with he and his team. So I can't rave enough about why I continue to work with Reed time and time again and all the reviews that my clients give him. So I will let Reed take it from here, but as you can see, he definitely knows the business and is such a wealth of knowledge. So Reed, are you there?
Yes, I'm here. Thank you so much, Tanya. And yeah, thank you everybody for being on the call. Pretty exciting year. A lot of stuff going on, a lot of big changes. So going to be fun to dive into this and really, give you guys a nice market update, as well as go over, updated guidelines and whatnot. A little bit about myself. I specialize in 1 to 4 unit property. So the loans that I'm going to be talking about mainly are conventional loans, and that basically just refers to Fannie Mae and Freddie Mac loans. Here in Orange County, where I live, that would cap at a $636,150 loan amount. But the average conforming Fannie Mae loan amount in the nation is capped at $424,000, give or take, and that's basically enough to cover most of these markets. Also, if the property is a 2-unit, a 3-unit, or a 4-unit, those would actually have higher loan limits. And if you guys want to Google Fannie Mae loan limits, and then just you'll have probably 5 different options there to choose from, and you guys can actually review specifically what the loan limits are for your market. Something else that I do want to cover is I'm now personally licensed and also branch licensed to lend in excuse me, California, Texas, Arizona, Tennessee, Indiana, Florida, and now Kentucky as well. So all of the markets that Marshall Reddick covers, I am now licensed to lend in. And then I also have my branch license there. And what's different about when you get your branch license is that all of the processing can actually be done for the loan in that state inside of our branch. So everything is in-house. And then, I bought my first property when I was 19, and I've been doing this now for over a decade. I'm 31 now. So yeah, definitely I've been around the block here for a long time. Been able to successfully help a lot of people buy property in the 2010, 11, 12 markets. Those people have done very, very well today, and just very, very excited to see where Marshall Reddick as a company is moving. Yeah, and very, very happy to be here. A little fun pick to kind of start off. This is me actually at the 19, back at the first mortgage company that I ever worked with. This is actually back within Marshall Reddick, American Direct Mortgage. So just kind of a fun picture to start with. Okay, and then the information that I'm going to be covering this evening. So 1, the importance of getting pre-approved. 2, the current down payment, credit score, and debt-to-income ratio requirements for conventional financing. Why are we going to be covering conventional financing? And really the answer, conventional financing offers the lowest interest rates and the lowest down payment requirements for investment property financing. We're also going to be going over a market update, specifically what impact that Trump has had, and basically what to expect with interest rates over the next 12 months. And then obviously what to look for in selecting the right lender. Okay, so moving forward now into getting pre-approved. Now, why is this important? If you're making $500,000 a year and you got W-2 income and you've got $500,000 of cash in the bank and you're renting for $2,000 a month right now and you have no auto loans, and if you've been at your current job for at least 2 years, you pretty much know that you're going to qualify. Either way, I still advise that it's better to go to a lender first and to get pre-approved for some of these reasons that I'm going to be going over. But obviously, if you're in that position, and if you're not going to buy in 6 months or so, you don't need to go and have your credit ran yet. It's still good, though, to get a pre-qualification on file. But understanding what your true buying power is, especially if you have a complicated file or if you already own 1 or 2 properties or if you have a partnership, right, or if you have multiple companies like many of our investors do. Always very, very important to understand what your true buying power is today. And now some other things to cover, why it's very important. Many potential buyers have incorrect expectations of their buying power. Knowing your true buying power will allow you to build a realistic game plan and will help you to shop for properties that meet your specific monthly payment criteria. Also, knowing the interest rates for these different types of loan programs and getting fully pre-approved and understanding the differences within each market, very, very important to do as well. So another reason why it's just good to go through the pre-qualification process. If you're not ready to buy today, it's still highly recommended. And then that way you know exactly what you're able to qualify for, and then you are prepared to move forward. Now, something that I do want to cover, you guys, is if you're not going to buy, though, for 6 months, we are happy to get all the documentation on file needed. We are happy to have you run your own credit. Send us over a copy of that. And then I have my underwriter here that will pre-underwrite your file. And then we can tell you, hey, here's what the payments are going to look like based off of your credit. This is what everything is going to look like ahead of time. You appear to qualify for 5 properties up to $1 million in loan amount. And then we can wait until you're actually looking at a few properties and ready to place an offer and then run the credit then. If you're looking, though, to get started now and you are going to buy, you believe, in the next 4 months, we only have to run credit 1 time, and then it's good for 120 days. We don't have to run it again. So by doing that, you will be able to get yourself fully approved to move quickly when you do find the property within the next 4 months. The 6 required tasks of getting approved: we have to do a loan application. We do need to run your credit. We then run your loan through the automated underwriting system with Fannie Mae. Fannie Mae is then going to give you a loan number and a list of specifically what we need from you in order to close your loan. We're also going to have you sign TBD disclosures. TBD refers to property is to be determined. And we're basically, let's say that you're looking at a $500,000 range where the property is, or it looks like you're going to qualify for around 500,000. We will run disclosures based on that amount, have you sign just some preliminary documents. We will run a 4506T tax transcript form with the IRS. All lenders have to do this. And what that is the IRS will provide tax transcripts showing the way that you filed your returns. My underwriter will then take the tax transcripts, match them up with your tax returns to see if there's any inconsistencies. Okay, we also do what's called an SS verification form. It's to verify Social Security. This can take 3 to 5 days. We like to order it at the beginning of the process. The last thing that we'll have to do is we'll have to get all the documents that are listed on the AUS. And, you know, just so any of you know, the most recent list of documents needed would be 2 years of IRS tax returns, 2015 and 16 W-2s if you're a W-2 employee. If you have a corporation, we would need the most 2 recent years of 1065s or 1120s. If you're W-2, just standard employee, we need 30 days of recent pay stubs. We need copies of your 2 most recent bank statements for the account that you're planning on using for your closing. And then we need a copy of your driver's license. So that's basically the documents that we're looking for that the AUS in general is asking for. Now, to take it a step further, you guys, one of the changes this year is if you're a cookie cutter buyer where you're W-2, you have no partnerships on your tax returns, you have no Schedule E, so you own no other real estate, you're just standard buyer buying your first home, okay, W-2 client, we now have a way to order verifications for everything on the back end, even including your bank account statements, and it's literally a no documentation approval, and we can approve your file and get you all the way to closing that way. It's a new Fannie Mae loan program that's available, and it just goes to kind of show how they're really trying to automate Fannie Mae mortgages, especially for primary home buyers, as we start to go into a higher interest rate environment. Another thing that we're seeing is you can now go to a max of 49.99% debt to income ratio on a Fannie Mae loan, and that's on even on your front end ratios. The front end ratio is the monthly payment for the home that you're buying divided into what you make every month. The back end ratio is that payment with any other monthly debts that you have, all added together, divided into your monthly income. Well, you used to be capped on the front end ratio around 38 to 43%. We can now take that up much, much higher to about half of what you make. So again, guidelines starting to loosen as we start to point to a higher rate environment. So back to getting pre-approved, we will have loan disclosures signed, we will get all these documents, and then we will actually submit your loan for a formal preliminary approval. This would represent a conditional loan approval.
Hey, Reed.
Now, yeah.
So I think this is an appropriate question. So kind of because it's what you were talking about. Somebody said, what's the difference between pre-approved versus pre-qual?
So the way that I like to call it is a pre-approval is you're having your credit ran and you're going through all of these steps right here. In some cases, not signing TBD disclosures, but still getting the borrower's authorization signed, the 406T transcripts in, the SS verification in, ordering the verification of employment and getting that on file. These things only take a few days to get done, but at least getting that amount of documentation and having the underwriter review it, not just the loan officer, but the underwriter's set of eyes, review it and getting a full pre-approval, that would be a pre-approval. Signing TBD disclosures would get you a full conditional approval, a little bit further. Take about maybe 3 to 5 days for that process versus a pre-approval that can be done within 24 hours. Now, a pre-qualification is you guys sending over your guys' credit, us not running credit yet, but reviewing your documentation, getting a loan application on file, reviewing all of your documents for all the accuracies, and then telling you, hey, this is what we believe that you will pre-qualify for. That's my example of what we would call a pre-qualification versus a pre-approval at my branch. Okay. Now, this is what most lenders would require because it takes a lot less man hours. Simple as that. A loan officer can do all these things. You don't need to have an underwriter do these, like run an application, run your credit, and then do the AUS. And unfortunately, especially if there's things like a short sale in the past or a BK in the past, or just something that's maybe not reflecting on the credit report, it's just always very, very important to have everything reviewed up front. Also, things like if you're not claiming all of the income on your rental properties, we see that all the time where there's no income being reported. Don't expect to be able to use any income on that property if you're not reporting any income on it. But sometimes you'll have a preconceived idea that that property is paying for itself, and a loan officer will not review your full tax returns because you'll send them the first 2 pages. You now get into escrow on a deal, and it comes time to send everything over. Now your loan gets denied because you don't have enough income. You got to go back in and potentially amend your tax returns. It could become a big issue. So do yourself a favor and use OPT, other people's time, and do yourself a full pre-approval always if you're serious about getting started right away. If it's about 6 months out or so, or if you're just not really sure yet that you want to have your credit ran and you know that your financials are very, very sound, then you don't need to have your credit ran yet either, right? Find out your market, find out whether you want to be A, B, or C class, or a combination of both. And that's something that you can find on the Marshall Reddick website. It's phenomenal. And Tanya, who's a real estate advisor, can help you to understand maybe what class that you would fit into more. And then once you find some properties to identify, then you can move forward with doing the full approval. And really what that does for you guys is it's just going to keep you fully prepared to move quickly also, so that when you get into escrow, you get your home inspection done, you're getting your appraisal done, and you have your full-time job and your life to deal with. You don't need to be working on digging up documentation that you could have gotten ahead of time. So it's really more of a convenience factor as well. Now, some commonly asked questions that I get regarding the pre-approval: how long is it good for? It's good for 120 days from the date that we run your credit. It used to only be good for 90 days, but within about the past 12 months or so, Fannie Mae updated this where now we can do it at 120, so that's great. What if you're not looking to buy for 4 to 6 months and are not ready to have your credit ran? I just went over that. Let's just do a pre-qualification. We'll tell you what you qualify for, and then you let us know once you want to get very serious on placing an offer. Before we place an offer, you have to run your credit. A lot of times, because the seller's agents are sharp and they go, hey, we want to see a DU approval. And if they're asking for that on Friday afternoon, okay, and we don't have the ability to send that off because we don't have your loan application yet because you wanted us to write you something ahead of time, or we don't have your credit and the ability to get that, then you're not going to look prepared and we're not going to get the deal. So again, make sure that you get a full pre-approval when you're ready to start placing offers.
Yeah.
How long will it take?
So basically, Reed is my go-to guy. Like, I have a listing I just took in Santa Ana, and on my notes, in order for me to even accept it, I need email confirmation from Reed saying that they are qualified in order for me to present their offer to my seller. So that's how powerful that is.
Yeah, and so what that's, thank you, Tanya. And what that's actually called, you guys, just so you can reference it, it's called a cross qualification. And many real estate agents have their preferred lender that they do a cross qualification, obviously on the offer. And any of you that are looking to sell a property, piece of advice, always make sure that your realtor has a lender that cross qualifies the offer before you accept it. I mean, and if it's an all cash offer and if the funds are from another country, be a little weary of that. It's just some things that we've seen sometimes. And that's something that having a great agent will really help you to determine when you're reviewing your offers. Okay. What if I want to purchase more than one property? So when we do a pre-approval, we're going to approve you for really more of a max dollar amount. And then I obviously send off pricing for a single family home with 20% and 25% down, because you get a little bit better interest rate when you put the extra 5% down. And then I also send off monthly payment information for a 2 to 4 unit, because the rates are just a hair higher when you buy a multi-unit property versus a 1 unit. And then I will always put on there that, how many properties that you're able to qualify for as far as like a dollar figure. And then is the pre-approval good for multiple purchases? So we have someone that was just going through a 1031, and we literally closed 6 properties for them. We were able to close them 2 to 3 at a time. So it doesn't always have to be simultaneously closed all at once. But I mean, again, we're dealing with clients a lot in this market right now where you're seeing a big wave of kind of selling your older properties to upgrade into more quality property. I'm seeing that a lot right now. And so in those situations, qualifying multiple properties at once is not going to be a problem. And that's something that we would just go over at the pre-approval stage. Okay, so how are we qualifying you? Anyone that's ever come to one of our seminars and watched me speak, I always go over debt to income ratio. This is how, so when lending guidelines changed, and anybody that could fog a mirror no longer met the guideline to getting a loan, and you had to qualify, right, with your income, your assets, and your credit on every transaction. That was around 2007. You started to, see the stated income loans go away. Well, everybody is still always qualified. You had to put an income there because lenders will always look at a loan based on the borrower's debt to income ratio, especially on a conventional loan. So debt to income ratio, a simple example. If you made $10,000 a month in gross W-2 income, this is an example, and the monthly payment for the property that you're buying, let's say that you're buying a primary, for example. Let's say it's a $4,000 a month payment, and that includes principal, interest, taxes, and insurance. And let's say any other minimum payments on your credit report, including minimum payments on credit cards, auto loans, any other loan that's on your personal credit report. Let's say that all equals $500. So now we're at $4,500. $4,500 divided into 10,000 would be a 45% debt to income ratio. The most recent guidelines, this is the same slide that I've showed for really the past 2 years because the guidelines with the lower FICO scores have not changed. If you have a 640 to a 660 mid score, anything above a 43% debt to income ratio, you're not going to get approved because Fannie Mae will not approve it through their online underwriting system. 660 to 680, you got a 45%, you're getting capped. Up until just about a 700, you're going to be capped at 45. 700 and above now is 49.99%. Now, if you have strong compensating factors, like a lot of money in the bank, and your FICO scores are in the lower range and you have high debt ratios, we're still seeing that get approved in some situations. You just have to have strong compensating factors. And for some of you that maybe had a foreclosure 3 or 4 years ago and you're looking to do like an FHA loan and you have a lot of liquid saved, but your credit hasn't made it back yet, buying a primary home, we can get you approved as low as a 600 mid score. And this is all something that we would go over in a pre-approval. Now, I also want to point out the credit analyzer software that we have. When we do a pre-approval, it's free because I'm just like a real estate agent where I'm an independent contractor in the sense that we don't get paid until your loan closes. So when we do a pre-approval, it's at no cost to you. On page 8 or so of every person's credit report is a credit analyzer. And it'll say on there, potential score improvement, 38 points, 12 points, 15 points, right? For each of your bureaus, you'll have an estimated score improvement if there is one. We'll then order the credit analyzer through Cisco. It'll specifically say, pay down this card or Amex by $2,500 and then show a screenshot and send it in. And then Cisco will then rescore the credit with each bureau and you can get your scores up. Now, the same thing goes if you have something derogatory. Maybe there was something on there from a while back that was already even paid, or it was paid in full, or it was even agreed to be deleted off, but they never deleted it off. The purpose of the pre-qualification is if anything is on that credit report, you don't have to go through a credit repair company. We have the ability to help you get the credit back in a good position. Obviously, we can't negotiate things for you. That's something a little different that I do see these credit repair companies advertising. But a lot of times, there's no real negotiation. It's if you have something on there, you say, hey, I want to pay this in full, but I want a deletion letter. I want it literally to say, this has been deleted from my credit because I paid in full. Then we get the deletion letter from you. We submit it into Cisco. They submit it to all 3 bureaus. It gets removed. We then can order a brand new credit report. Okay, I've gotten credit scores from a 660 to a 717 mid-process. Recently this happened, and the borrower saved about 3/8 of a point in interest rate. Okay, so this is something that if you think your credit is not that great for some reason, but you've got savings and you know the income is good, your debt to income ratios are solid, you've had a good job over the past few years, you've experienced some wage inflation growth, right, with the economy, so maybe you're making more money now too. get a pre-qualification so you can see if there's an ability for us to help you, really improve that credit. Because unless it's a foreclosure or a short sale, a lot of times it's just because there's something still on there lingering, or it's because you're utilizing way too much of your available credit card usage. Now, example, if you've got $10,000 in available credit card limit on, let's say, 4 different cards, and you're using $7,000 a month of that and letting that revolve, that's really, really, really going to hurt your scores. In general, want to be anywhere, below 25%. And you guys, Credit Karma is a great free online system that I use even for myself, and they've got a lot of great tips on there for you.
Hey, Reed, a couple people were wondering, what is Cisco? You said run it through.
Oh yeah, no, Cisco is they're a large information company essentially, and Cisco is who we order the credit report through, and then Cisco pulls all the information from your 3 credit bureaus: TransUnion, Experian, and Equifax. And if you Google Cisco, you'll learn a lot more about them. Okay, couple little notes here. Okay, make sure. Okay, after you've gotten pre-approved, some things that I have on here, don't do these things, but really what I want to kind of reiterate is, don't do any of these things without calling your loan officer first and letting them know. So after you've gotten pre-approved, don't apply for or open new credit of any kind unless you've asked your loan officer first. Okay? Don't max out or overcharge on your current credit cards. Don't consolidate credit card debt. Don't make any large purchases. And then don't make large deposits in any of your accounts. I mean, example on just a couple of these, you don't want to make large purchases that maybe, let's say you go finance a car that's got a $600 a month payment, and you think because you already got pre-approved, well, they're not going to rerun my credit, so they're not going to see this. That's incorrect, because the underwriter will do a soft pull of your credit after you enter escrow, okay, to see what your current trade lines are, and also to see what the payments are. See if you've been using more of your credit card debts, and now there's a higher minimum payment to hit you towards your debt ratios. If they see a big payment on there for something new, and we had you approved right to that max debt to income ratio requirement, okay, and now you're over it, you're going to have to pay off that car, or we're not going to be able to qualify. So just an example of just let your loan officer know what you're doing with any of these things right here. And then things that you really want to do while you're in that process of really seriously looking for a property: do maintain employment at your current job. Do keep all existing credit card accounts open. Do pay off any collections, judgments, or tax liens that have been reported within 1 year that your loan officer tells you that you need to pay off, because they will have to be satisfied and paid to even get it approved. But again, if there's anything open on there, this is something that your loan officer and the underwriter essentially should be communicating to you at the beginning of the process when you get pre-approved. And then do stay current on all existing accounts and financial documents. I always say this, that if you're late more than one 30-day late on a mortgage within 12 months, Fannie Mae will not approve your loan. So mortgage lates are just, it's like the end all say all. They're very, very hard on your credit. So just always make sure that you're on time with everything. Perfect. Oh, and one thing that I did want to also cover here, when I say maintain employment at your current job, we work with a lot of engineers within Marshall-Reddick, and sometimes we do see that there's been a significant amount of just raises or different types of opportunities being thrown from different companies, specifically up in the Bay Area. I have one guy, he's been offered like literally 3 different jobs in the past 3 years. Each job has been double in income every single time. So obviously it makes sense to move. If for some reason you're 2 months into your 4 months of being pre-approved, haven't found the property yet, but you got to make a job move, just make sure that you're going W-2 to another W-2 job. If you take a partnership position and now you're, fully self-employed, all your income's 1099, we now would need to see 2 years of history with you being self-employed before you can qualify. So just make sure if you have to move no matter what, that you're always going W-2 to W-2. Or if you're self-employed and now you're going to be W-2, then that's also fine. We just would need 30 days of pay stubs at the new job in order to be okay under either of those scenarios. So I just want to cover that. Okay, so down payment requirements. This is a new change that's happened, which is very, very exciting, because many of our investors have already got, over 4 finance properties. You now, up to 6 finance properties, can come in with the minimum down payment for buying an investment property. And the minimum down payment on buying an investment property starts at 20% down. And then a 2 to 4 unit property is going to require 25% down. Now, you used to only be able to do those minimum down payments up to 4 finance properties, and then 5 through 10 would always require an additional 5% down for each. But now you can at least go up to 6 financed, and then 7 through 10 finance properties is going to require 25% down minimum on a 1 unit, and then 30% down minimum on a 2 to 4 unit. Also, I want to point out the FICO score requirements. So you can get approved up to 4 finance properties with as low as a 640 mid credit score. But for properties 5 and 6, DU will require 700 mid score. And then for properties 7 through 10, you've got to have a 720 mid credit score in order to qualify. Now, some other information, okay? Cash out refinances are now allowed on investment properties when you have more than 4 finance properties. Many of you who have owned 7 or 8 properties with a ton of equity over the past 5 or 6 years have not been able to pull any cash out of an investment property because you had over that 4 finance limit. And for about the last 6 months, Fannie Mae loosened up that guideline. You can now pull cash out. So pretty exciting for any of you that don't know that. Some other things that you need to know to get to 10 finance properties. And you guys, 10 finance properties is the max amount of finance properties that you can own and still get a Fannie Mae loan for buying an investment property. Now, that doesn't mean that you can't have a first and a second or even a third, right, tied on 4 or 5 of those properties. It's not about the amount of loans that you have. It's about the amount of individual finance properties that you have. Okay, and commercial loans, they do not qualify. Okay, something else. If you have 25 finance properties and you want to go buy a primary residence, this rule will not apply. You can go buy a new primary residence. It's only investment properties that you're capped at 10 finance properties. So again, just some of the changes that I want to reiterate again: must have a mid FICO score of 700 to get properties 5 and 6, and a 720 mid score for properties 7 through 10. You must have 6 months of PITI in reserve for each property, and that's principal, interest, taxes, and insurance. If any of those properties have an HOA, that's going to be included as well. And that just means you need 6 months of payment for each of those properties in a separate account on top of your down payment and closing costs that's listed on the loan and that's been verified. You would need that in order to qualify. Now, rental income can still be used to offset the monthly payment towards your debt to income ratios. So for example, if the monthly payment for the property that you're buying is $750 for principal, interest, taxes, and insurance, and if it's renting for $1,000 a month, verified at $1,000 a month, 75% of $1,000 is $750. That property would pay for itself. When we qualify you on your debt to income ratios, that property would not increase your debt to income ratios. So that's how some people that are already at 49 are still qualifying to buy more property. Some people that are at 55 are buying a fourplex, and now they've got more income coming off. The property more than pays for itself, and we get their ratios down low enough to qualify. So that's a pretty cool rule. It's been there for as long as I can remember, and yeah, it's definitely allowed still up to 10 finance properties. They don't hit you for that. And then the max debt to income ratio, once you're at 7 to 10 finance properties, caps at 45%. Some other things that you need to know: it's only for 1 to 4 unit properties. You may have multiple loans, but can only have 10 finance properties. I covered that. May purchase or refinance primary residence regardless of the amount of finance properties. I covered that. And then it's only available for 15 and 30-year fixed loans. Frequently asked question: does subject rental income count towards my debt to income ratio? Yes, I just covered that. 75% of the gross income. Now, what if the property is not pre-leased? Some properties, through Marshall Reddick, they've already got a tenant in there. Some don't. If the property is not currently pre-leased, one of the documents that's included with your appraisal report when we order your appraisal is a 442. And that is a rental comparable analysis of all subject properties within about a 2-mile radius and what those rent for. And then the underwriter, right, will give you 75% of the average rent and then use that to offset the monthly payment towards debt to income ratio. Okay, time for a second poll. Let's see if, Tanya, let's see if we have any other questions.
Okay, so before the poll, just for clarification on that debt to income slide on the percentages of how much debt you could have based on your FICO score, Sylvia had a question about like yeah, great. So if you could explain on that, like very first one, if she has a high or a low FICO score, like let's say she has a 680 to 700 mid FICO score. So she can only have how much debt versus income? She can only have the 45% max.
Roughly 45% max when you're buying an investment property. If you're buying
Debt.
a primary home, yeah, debt.
45% debt, not your income. And how does that impact you? Is that before you get the new loan, or are you adding that into the new loan?
It isn't. So what it includes, again, it's going to include all the minimum payments on your personal credit report. So any auto loans, any student loans, any other, any other personal loans, anything that's, I mean, if it's tied to like an EIN number because it's tied to like a business, we won't have to include that. But anything that it's on your personal credit report and the monthly payment for the property that you're buying. All those monthly payments, you then divide that into your gross monthly income, and then you're going to have your debt to income ratio, what they are.
So does that matter if it's for a primary home versus an investment home? I think Michelle was hoping
Yes.
that.
Yes. So let me explain to you how. So the reason why when you're buying a primary home, there's no way to get any subject rental income to offset your monthly payment unless you're buying like a 2-unit, a 3-unit, or a 4-unit. Then you'll have subject income to help with that monthly payment. But if you're just buying a primary home, a single family or a condo to live in, let's say that payment is $3,000 a month. And then any other payments on your credit report, minimum payments, right, included with that $3,000 a month, we then divide that into the gross amount that you make each month, and then you get your debt to income ratio. So when you're buying it as an investment property, the only difference is you're going to rent that property out. So we can give whatever the average rent is on that property, we can give you 75% of that rent amount towards whatever your payment's going to be to offset your debt to income ratios. So that's the big difference between buying as a primary and then buying as an investment.
Hope that helped, Michelle. And then I have another question here. How are HOA fees included in the debt to income? Is it
Yes.
part of the payment?
Yeah. So any monthly carrying expense on that property is going to be included in the debt to income ratio. Now, not like your utility bills or anything like that. Just the monthly carrying costs like property taxes, homeowners insurance, HOA dues, and then principal and interest on your loan. Also, some communities will have what's called Melrose tax. Usually that's just additional funds that the city has taken out to improve the area, and then that essentially increases the property taxes in that market until the loans have been paid back. So basically all of that, right? If there's any Melrose, the property taxes, homeowners insurance, HOA, those are and then the principal and interest on the new loan. That's what's going to be included. Yeah.
Okay, and I have a question from Rodolfo. This is kind of specific, guys, and Texas is different than Florida, California. So let's have Reed elaborate here. He says, I have one rental property in Texas. I owe $99,000 left on the loan, and it's valued at $200,000. I would like to refinance and get money for a new down payment for a second investment. Is that doable? What is the maximum I can cash out? And it also depends, Rodolfo, type in how many properties you have financed, please. So go ahead, Reed.
So Texas now does allow you to cash out on an investment property. We've successfully been able to do that. And for a long time, they were very, very conservative. But now we have lenders who are able to do it on a Fannie Mae loan. And you can pull cash out to 75% loan to value.
And still today up to 75%. Great. And he has 3, so that's good. I think, isn't it after 6 you cannot? What's that cap, Reed?
No, well, so you can still pull cash out now up to 10 finance properties, and that's not going to be an issue. And that was one of the things that I had covered earlier, that you were capped at 4 finance for a long time, or
Yeah.
forever, and now you can go up to 10. But I mean, again,
For
there's
the
no
cash
way
out
to get
refinancing?
for cash out, and
Nice.
there's no way though to go above 75% loan to value. So there's no 80% cash out for an investment property. It's going to be capped at 75%, even if you had under that 6 properties. So just know that too.
Great. So I think that was a 2-for-1 for Sylvia as well. Thank you. Okay, let's
Perfect.
do this poll, guys, and then we have some more questions. So here we go. Here is this second poll.
Okay. So do we have
There's
any
a
other?
lot of questions. So we'll get to them. All right. Can you guys see this? Yes. Which of the following applies to you? I'm considering to purchase but haven't spoken to a lender. I've spoken to a lender but haven't been pre-approved yet. I have been pre-approved within the last 6 months, so that means that it's not valid anymore. But you kind of have an idea unless you haven't, done a lot of big purchasing. So the last one, I can't qualify right now, and I'm just here to learn, which is good. I'm glad you're here.
Great. Awesome.
Okay, keep on voting, guys. And keep asking questions because, I'm going to provide all these questions, especially if some of them are extra specific to you. I'm going to share these with Reed, and then you guys can have a one-on-one on a focused conversation. All right, guys, I'm going to go ahead and close this poll out. So if you guys can get in all right, closing and sharing. So we have a
Perfect.
tie between the first and the last. So people are here to purchase, but they need to figure it out. And then some are just here to learn. So
Great.
awesome.
Okay, so we're going to move into some fun stuff. You guys talk about what's going on in the market. Our favorite 5-letter word, which is Trump. Very interesting. Some of the changes that we've seen. I love the phrase "trust but verify." So I'm going to actually go over a pretty cool screenshot here in a minute to kind of really show you guys visually what's been happening with big money on the back end since he was elected. But we're going to start off with the 30-year fixed mortgage rate with a graph. Now, you guys, this only goes through 2014. I've been looking online for a long time for a great graph of the 30-year fixed that shows from about the 60s to current market. If anybody has that, please email it to me. I will love you forever. If you guys have not been able to find it, but this is the coolest graph I've been able to find that really shows you, as far as on like a line chart, really how high the 30-year mortgage rates were at one time. My dad was buying property back in the early 80s. I mean, he had even told me, obviously, rates on a 30-year were 18.45 at their highest. Now, you could park your money at a CD in Bank of America and make around 10%. So everything is relative to its environment, but and I'm sure the property values were, obviously a bit lower at that time too. But I mean, you guys, just to give you a really good idea, I mean, we're really at about a 4% rate right now, 30-year fix for primary residence. On the best day, you're back at about a 3.875 without paying any discount points. And discount points refers to paying 1% of your loan amount to get a slightly lower monthly payment, to get a little bit lower rate. So, I mean, to be at that level still, after we thought, when the Fed stopped their quantitative easing, 3 years ago, which they never really stopped it, and I'll go over that here in just a minute. We thought when that was going to stop, hey, rates were going to go back to at least 5.5 on a 30-year, and they're not there. They're still around 4. So pretty phenomenal. The average rate today for a 30-year fixed loan for an investment property, putting 25% down, is going to be about 4.5%, give or take, without paying any points. Now, why do interest rates matter so much? Does a 0.25% rate really matter that much, or 3/8 on a $100,000 loan amount? Not going to make that big of a difference, you guys, okay? But take it into perspective. Every 1% rise in interest rate on a $200,000 loan amount is a 12% increase in your total monthly payment. So we're all numbers people on this call. Just think about that, right? Even if you're not a numbers person, but if you're an investor or if you have the mindset where you really want to build some wealth in real estate, think about what a 12% increase in your payment is. And that's only a 1% rise in rate. So, yeah. Okay, here's my chart, you guys. This is going to look like a different language, but I'm going to break this down so you all fully understand it. Now, this is the Fannie Mae 3.5% mortgage bond. This is the most closely tied mortgage-backed security or bundle of mortgage loans tied to the loans I've been talking about today. The Fannie Mae 424,000 average loan amount size in the nation. Okay, green means investors are buying the bond, causing the bond to appreciate, driving down the yield. Okay, making rates better. Red is investors selling the bond, causing the bond to depreciate, driving up the yield, okay, making rates worse. Just like supply and demand. Less people wanting to buy, it's going to drive up the price, okay? More people wanting to buy this security, it's going to drive down the price, or actually, it's going to drive up the price, but it is going to essentially drive down the yield, and it's going to make rates better. So look at this graph, right? You've got the pink line is the 100-day moving average where rates have been for the past 100 days. Purple line is the 200-day moving average for where rates have been for the past 200 days. I've highlighted the first highlight is the highest price ever paid for a mortgage-backed security, meaning it had the lowest yield, the lowest rate ever. Okay, that was right around September of last year. The second highlight, what do we all think that is? That is Trump. Okay, that is the entire that is the world betting that now we're going to see higher inflation. Okay, things like tax reform, okay, they can put a lot more money back into essentially companies and people's pockets. That's what the idea is, right? And then they would filter that money back into the economy, okay? This new government is, or rather this new Fed approach wants to see really around a 3% growth rate or even more, okay, before they let 30-year fixed rates go back to 6% on average, okay? Under the last administration, they wanted to see 2%. Well, we're at about 2% year over year. Wage inflation's at 2.4% year over year, but they want to see 2.6 plus before they really, do another strong hike on the interest rates. Okay, so again, you guys, you can see it with your own eyes. This is a gigantic fundamental shift. That's why your retirement account is probably up 15% since Trump was elected. Mine hasn't done anything for over 3 years. So, you guys, we're in an entirely different economic trajectory now because of the shift that we've seen. And what I've highlighted here next is this next highlight, the third one over, that is the second time in a decade that the Fed raised interest rates. It was a hawkish hike. They raised it by 0.25%, but they also put 4 rate hikes on the table for 2017, okay? The market rates got to the worst levels after that. We then bounced up a bit to find some support up higher, okay? We then traded worse for the next couple of months, and then up until our third rate hike that we had back in March. You see how the market was expecting a very hawkish rate hike again, because the market by that point was hoping to see, 2.5% plus on our GDP and on inflation. Well, it came out right around 2%. Okay, and it wasn't quite hot enough, and the Fed only raised another 0.25%. They did hike at that meeting, but then what they did is they took 2 of those 4 potential hikes for 2017 right off the table. As a result, mortgage-backed securities improved. Then you had a potential French Brexit happen, right? That's more volatility. Then you also had a lot of this Trumponomics, these different things that he wanted to come out with, not really happening, right? Congress putting a kaput on many, many things, right? Healthcare still not really making any movement. All of that, because of the volatility, push money back into bonds as a safe haven. But money is still continuing to go into stocks as well. It's not like the money didn't stop going into stocks, but you're seeing a good balance of money still moving into bonds as a safe haven. Because if the stock market drops 10 or 15%, a Fannie Mae mortgage-backed security is still paying 3.5%. And right now, that's way more than inflation, right? So very, very cool, in my opinion, to still see that we're in these levels. It just goes to show that we're not getting the type of inflation we were expecting. And until something like, I mean, honestly, I don't really believe that healthcare is going to pass right now. I think that's pretty obvious. Congress is kind of doing their own thing anyways, and they're going to make some different changes regardless of what Trump wants to do. But the biggest thing now, you guys, to focus on is what's going to happen with tax reform. Because if they come through with tax reform and big money likes it, which they're probably going to like it, if they come through with that, then that's going to be the inflation that we're going to want to see moving in towards the end of the year, that we're really not going to probably see it until next year. And when that inflation hits, that's when the Fed is going to stop what's called stealth QE. And I'm going to spend a couple more minutes on this because it's very, very important. I was talking earlier about quantitative easing. If everybody remembers, you had QE 1, 2, and 3. And that's when the Fed was buying, on average, $55 billion a month in Treasury bonds and about $40 billion to $50 billion a month in mortgage-backed securities, okay, mortgage bonds. So they were buying up their own debt that we issue, and they were buying up our mortgage debt, okay? They got to a point where they had exhausted it, and they said, okay, we're no longer going to, or we're going to start tapering back on what we buy. And all year, and I believe it was 2014, they tapered back until they no longer were buying. But what no one realizes is that they just bought till they got to a certain amount, right around $4 trillion. They got to about $1.7 trillion in mortgage-backed securities. Then what they do, every week when a lot of these loans are paid off, okay, they need more money to come back in and buy these bonds up again. Well, Fannie Mae is coming in. They're using all the interest they make on that $1.7 trillion, and they're rebuying $7 to $12 billion a week in this bond right here. All right. They've actually, this is called stealth QE. They've actually been buying more mortgage-backed security. They've never bought less. They've actually continued to buy more and more every month, but it's being done behind the scenes. Also, the government mandates big banks, okay, to buy 25% of all available mortgage-backed securities. They're also mandating, okay, big banks to buy our treasury notes. I mean, all this makes great sense, right? Because if you're issuing debt, what's the best way to lower the amount of money that you're paying on that debt? Force your big banks to buy it at uber low rates, okay? And that's what's been happening. Right now, you still have, regardless of what economic data comes out, the Fed is still going to buy 7 to 12 billion a week in mortgage-backed securities, and they're still going to mandate the banks to do it. They're still going to continue buying their treasury notes, and they're still going to keep on making the big banks buy it, okay? Until now it's looking like they're potentially coming out finally and saying in September they will start to trim their balance sheet, which means that this $4 trillion amount of debt that they have that they're making interest off of and just rebuying off of, that they're going to start pulling back on the amount that they buy each month, okay? Now remember, you guys, 25% of this bond being bought is by the government, Fannie Mae and Freddie Mac. 25% is being bought by the big banks. The other 50% is being bought by other world banks, okay? Other large institutions like insurance companies, okay? They're just following what the Fed's doing, okay? If that 50% was not being bought, interest rates would be 3% higher today. It's a fact. So it's about how long it's going to take them to unravel this gigantic stockpile of bonds that they have, okay? And it's going to be a while. Are they going to let rates fly up overnight? No. Okay, they don't want us to run right back into recession, okay? They want to wait and see till we've got really, really solid wage inflation growth and solid GDP growth in our economy, where they have got to have higher rates. Otherwise, we're going to start appreciating to a very unsafe level. And we're just not there yet, you guys. So you're in this beautiful Goldilocks period, right, where you still have low rates and you have rising asset prices. It's a wonderful time to still buy real estate. And that's my market update. Really what I want to end with on it is that for right now, I believe through the end of summer, we've got a huge floor of support for rates where they're at. As you guys can see, we're trading just above our 200-day moving average. We're trading above our 100-day moving average as well. That's bullish for interest rates, mainly because the Dow just hit 22,000, right, today off Apple, and we're at all-time highs. And big money is a little bit worried that, hey, maybe now it's going to be time for some serious profit taking. That, along with the fact that healthcare hasn't passed yet, Trump's losing a ton of support right now. I think he's at like 30% support from like 50% from people my age. And you know what, you guys? All that volatility is going to be good for mortgage rates, okay, until tax reform. So, okay. If you guys want to be placed on my weekly market update, it's totally free. It goes out every Saturday. It's also posted on our Facebook page, Rodriguez Hazard Team Facebook page, every Saturday. So send me off an email, and we'd obviously love to have you. Some important tips for selecting the right lender. I know that some of you are on the call for that. Just some things, especially, this is some things also for if you're going to be buying a primary residence. Most use local appraisers. You know, at my company, the appraisers company must show that they've done appraisals within the same zip code within the past 3 months. Just a quick little example. If you're buying a property in, let's say, Newport Beach, you wouldn't want someone from Rancho Santa Margarita, which is an inland city of Orange County, to go out to Newport Beach to appraise the property. And because they're not an expert on that market, they don't know that maybe 2 streets over properties are going for $500,000 more. But why does that happen? Because big banks get so busy, okay, that they don't have the time to vet the appraiser, and when it gets too busy, they have to start sending out outside area appraisers to go to different locations. And when that happens, you get a low appraisal. And if you get a low appraisal on a property, okay, let's say you're buying a primary for $800,000 and it appraises $100,000 low because the appraiser doesn't know what he's doing, and you had limited funds, and now the lender can only lend off $700,000, and you got to come in with the difference, or you might not have that deal now. And look, it's not like the deal wasn't worth $800. It's because the appraiser botched it. Now, sometimes a property may appraise low because it wasn't at the sales price, and that's a good thing if it's not at the sales price. But again, you guys, a lot of times this happens where you've got just someone that doesn't know the market going out and appraising the property. So very, very huge. Always ask your lender that you guys are applying with, if they use local appraisers, include them on that. Must be a direct lender. What that really just means is the company originating your loan is also the company that's funding your loan. So they're the source of the money. Dedicated in-house processing and underwriting. What that pretty much means is that everyone that's working on your loan is also in the same branch as your loan officer. Must specialize in purchase transactions. Must have a unique online presence. I mean, it's just really good if your loan officer has got a good 5-star rating online. Kind of like Tanya and I were covering earlier, that sellers agents are really going to pre-qualify your offer, and if they see that that your lender is really, really good at what they do, that's definitely going to stand out. Must be available on evenings and weekends. That's just hands down. And if you're not going to be available, then have someone else that is, always. Must be able to produce a loan approval that does not require a loan contingency at the offer stage. And that's that TBD approval I was talking to you guys about. It's a fully underwritten formal approval. You can close in less than 15 days if needed. We have something called the 8-day close here. It's the fastest that you can close possible, okay? It's a fully TBD approval. Everything's ordered on a rush, and we've literally closed in as little as 8 days if we had to. Okay, I don't want everybody here to be coming to me for 8-day closes, okay, unless you're going to do a fully underwritten approval. But if you do, that option's available to you, so you can look as good as an all-cash offer. Now, many times, you want to give yourself at least 15 days, because especially when you're buying an investment property, because there's things like the home inspection and the appraisal, and these things need to be reviewed in depth by you and by your realtor, real estate advisor, realtor, so that nothing is overlooked and you don't buy the wrong property. So yeah, again, very, very important at that offer stage. If you can write an offer with no loan contingency to a seller, it just shows them, man, these guys are fully approved. Their loan is not going to be a problem. Just an example of our reviews. This is my partner, Al Rodriguez. Marsh Reddick exclusive. This is just, for anyone that buys out of state, this is an appraisal credit up to $450. If it's in state and if it's for a primary residence, obviously the exact same thing would apply, and it's redeemable at the time of close. This is my office. We're down here in San Clemente, California. We've been in the old historic City Hall building now for going on 4 years. Yeah, I'd love to have you guys down anytime. We've got a great Mexican restaurant right across the street called South of Nick's. If you want to come down and do a pre-approval in person, then go out to lunch. I'd love to do that anytime. But yeah, this is our office location, and we're right down off the 5 freeway in South Orange County, last city before you go towards Oceanside. A couple pictures of me and my team. Obviously, bottom left, that's me and Chelsea. She's my soulmate, and that's my little baby, Liv. She's about 1.5 years now. And yeah, just so excited. We bought a home here in San Clemente and relocated from Aliso Viejo about 2 years ago. And remodeled our home, and we love it. We're on T Street over here, which is a famous beach street, with a famous surf break at the end, which I actually grew up next to. So super excited to be building my life down here. I've got great partners and just a great team put together. Ross and Scott over at Marshall Reddick. I mean, we've been partners now, I think now going on almost 14 years. And so just very excited to be a part of Marshall Reddick. On the very bottom, you'll see my team as far as my loan officers. Al Rodriguez, he's my partner. We've been partners now for about 6 years. Mike Gainey is one of our loan officers. Brian Kane, you will be working with Brian inside of Marshall Reddick because he's one of my production managers and also a loan officer. So Brian helps communicate documentation needed throughout the process, and he's actually included on all of my emails when our first contact goes out. So you'll be working with Brian on documentation and whatnot. And then Norma Jean, Travis, and those are both loan officers that work with me here at the branch. Travis does a lot of follow-up with me. Travis will be calling each of you just to say hello and maybe set up a time for us to talk and see if you have any personal questions. So he'll be calling everybody on the list. If you don't want to talk, if you don't want to work together, no worries, but just do expect a call. And then Samira Hurd, she's my agent relations and business development manager. And Samira just goes so far above and beyond to help us all market our business. She works closely with Marshall Reddick, and you may see her online, and she's always here in the office. She does a lot for us as far as for flyers and whatnot, and she's just a huge asset to have on the team. So she's been on our team for a little bit over 2 years. And that's it, you guys. That's all my information right there. Feel free to contact me anytime. Like I said, Travis will be doing follow-up calls. And for any of you that need to reach me in the meantime, that's my cell. And thank you so much for the opportunity to be here. It's so fun to be presenting on this subject again in 2017. I do want to leave with the note that as interest rates go up, you will see guidelines loosen. And we're already seeing that with some of the stuff that I mentioned today. Example, I never thought that cash out refinances up to 10 finance properties would ever be available again. I mean, it's here now. So it never hurts to ask. If you don't think that you qualify, or if you think something's a little bit off, always ask your loan officer, find a good expert, always call me with any questions and I'll always be available. So yeah, thank you so much, Tanya. And thank you, everyone.
All right, thank you. Reed, if we can go 2 slides. Next slide. So we've answered a ton of questions, and Michelle, I'm just going to go ahead and email you and Reed directly with your specific questions about your purchase. So I'm going to go ahead and do that. But just to kind of recap, what you can expect from a consultation with an advisor like myself is, setting why you want to do the next step. And then next, if you could just go through the whole rainbow, Reed, that would be awesome. So it's basically, why you want to invest. And then next is, let's see here, how you're going to invest. Basically the why, how, when, what, where, who, So that's basically the whole thing. So I tell you how to evaluate the options, and that's basically getting started on, talking with Reed so that you can basically learn how you can get there, when you can do it, deciding on a time frame of how we can get you there, and selecting criteria like A, B, C. That's kind of how we pick the market and how much money you need in your bank account in order to start buying in a market that makes the most sense for you, and where. So most importantly, all the key players. I would be a beginning step, and then I hold your hand throughout the entire process. I've helped over 350 people successfully buy property. And I'm not just there for the sale. I'm there for anything that comes up later because I have great working relationships with all of our property managers, our lenders, anything that comes up, insurance issues throughout. I don't want it to just be a transaction. I want it to be a long-term relationship. So this is my contact information. If you guys could please type in, yes, I want a consultation. I know my assistant, Daniel, will be reaching out to you as well, and a lot of you that I've been chatting with one-on-one here. Of course, you and I will be in touch, but this is my direct number. Please go ahead and take that down. I'll be sure to follow up and send you guys an email. Who would like a recording of this presentation? This was a ton of information. If you go ahead and type yes, I'll be happy to send you, everything, the PowerPoint, so you can look at the slides one-on-one. That way, when we're talking, or you and Reed are talking, we can specifically talk about what it is that you need answered. Thank you guys so much. Thank you, Reed. You're such an asset, and I really value this
Thank you.
relationship that we have. So I hope you all have a wonderful evening, and I hope that this was very beneficial for your time.
Thank you, guys. Thank you so much.
Thank you. Bye, all.
Bye.